Hi everyone, this is Jonathan Blackburn with the Texas PACE Authority. Today on our webinar we're going to be discussing the technical standards that all of our commercial PACE projects will have to meet. Specifically, we're going to be discussing two things. First of all, the energy savings analysis that all of our projects will have to provide. And second, we'll discuss the independent third-party review that all of our projects will undergo. Today's webinar is composed of 5 parts. First, we're going to give an overview of the technical standards that we've developed. In part 2, we're going to discuss the baseline case in the energy analysis. In part 3, we'll discuss the projected case in the energy analysis. In part 4, I'll show you how to calculate the savings from that analysis. In part 5, we'll discuss the independent third-party technical review, and then we'll close it out with a round of Q&A. I want to start with an overview of how PACE is being deployed from a technical standpoint and give an overview of the technical standards that we've put in place. Texas is a high bar state for PACE project approval, and what I mean by that is that in Texas we require a more thorough analysis than might be found in some other states' PACE programs. That high bar was originally set by the Texas state legislature, and now it's enshrined in the state PACE statute. And they had a number of reasons for setting that high bar. The primary reason is as a consumer protection. From the owner perspective, we want to ensure that all of our projects are going to likely deliver the savings that are being claimed. From the capital provider's perspective, we want to make sure that the projects that they are funding are good investments in the energy efficiency space. And then from the local government's perspective, we want to make sure that our projects are serving the local business community and achieving the public policy goals that the government originally had when it started the program. So what this really means is that we're only going to approve projects that are not just environmentally sound, but also economically sound. And in order to justify that, all of our projects are going to have to submit a cost-benefit analysis. That analysis is going to have an accounting both of the cost of the project as well as an accounting of the financial benefits due to the project. So that cost-benefit analysis really is going to take the form of an energy analysis. That energy analysis will need to conform to our technical standards that we've developed. That analysis really will be performed by the contractor or the engineer on the project, and there should be 2 components to the analysis. One is going to be a baseline, what is the building currently using in terms of utilities, and the second part is the projected case, what will the building be using after the project is installed. On the technical side of a project, there are really 2 parties that would participate in that aspect. The first I've heard termed a number of things: contractor, developer, the engineer of record. This is the party that will actually be doing the energy audit or creating the energy analysis. And then the second party is what we call the ITPR, the Independent Third Party Reviewer. This is the party that will look at that energy analysis that was prepared and review it as an independent third party. Now, one of the important things to keep in mind about our program is that there needs to be an arm's length relationship between those 2 parties. And what that means is that there are no financial overlap and that the parties truly are independent of each other in order to ensure that the analysis that is done is really independent. One question I get a lot is how extensive should my energy analysis be? And the answer is it depends. It really depends on the complexity of the project. And we have really 2 designations that we informally use to classify projects in terms of how complex of an energy analysis needs to be provided. We call the first category is fast-tracked, and these are projects that are single measures, like-for-like replacement, and distributed generation. These tend to be simpler projects, and in most cases a spreadsheet type analysis is going to be okay. The second type are more complicated projects that have multiple measures that influence each other. These we kind of term full assessment. And in most cases, projects like this are going to require an ASHRAE 2 style energy model. Some background on how our technical standards were developed. Our technical standards were developed by a group of stakeholders led by some staff at the State Energy Conservation Office at SECO. We haven't invented any new protocols or any new standards. We've really just relied upon kind of the industry standards that are already out there. Primarily, we're relying on the Investor Confidence Project, or ICP. This is a set of protocols for standardizing energy efficiency projects so that external investors know that the projects they're financing are consistent. Some of the other protocols we also reference, things like IPMVP, ASHRAE, ASTM guidelines, all are well recognized and well established protocols for evaluating projects in the energy efficiency space. The main thing I want to accomplish today is to walk through a project from beginning to end. And from the technical side, there really are a number of steps that will happen with any project. And to start with, the very first step that will need to happen is there will have to be that energy analysis that is prepared by the contractor or the developer. And so that's what I want to discuss at this point. So at this point in the webinar, we're at part 2. We're discussing the energy analysis, and we're going to start with the baseline energy use case. The baseline for the project represents the do nothing scenario, or the business as usual scenario. In order to do a baseline, there are some things that you will have to have, some must-haves. The main one is going to be utility data. You will need probably at least a year, ideally more than that, worth of utility data. In some cases, which we'll discuss shortly, you might want to weather normalize that data. If there has been a renovation occurred in the past few years, you'll want data at least back to when that last major renovation was. You'll need to know things like occupancy rate and hours of operation. How is the building operating? You'll need to know what equipment is currently there. Okay, so the current equipment plus the performance of that equipment. And finally, in order to do a financial analysis, you'll need to know the customer's utility rate structure. How do they actually pay for the energy and water that they're using? So beyond the must-haves, if you're doing a full assessment that requires a building energy model, there might be some other things that you need as well. In some cases, you need weather data or the files behind that. You might need to know load profiles of the equipment, as well as the layout of the building and the square footage. Some of you are probably asking, what is weather normalizing, or why would I want to weather normalize? And so I'll explain that. Weather normalizing is a technique used to smooth out differences in weather between different years. And we know that in any given year, the weather might be hotter or colder than normal, and that's going to affect how a building uses energy. And so for some measures, for some technologies, weather normalizing can be very important. Specifically, if we're talking about HVAC, heating or cooling, weather normalizing can be extremely important. In hotter years, the building will use more air conditioning. In colder years, the building will use more heating. And you want to smooth out that variation and make sure what your analysis is truly represents normal weather. For lighting, for projects like LEDs, weather normalizing likely is going to have a pretty minor effect. Weather really won't affect your lighting use that much. And then for solar technologies, most of the production models that are out there already consider weather. They already take weather into account. So weather normalizing is really not going to be that important for solar either. When you're doing your baseline, the main piece of advice I would have is that to verify your approach with Texas Pace Authority and with the ITPR, if possible, and you want to do that as early as possible. If you've ever got any questions, is what I'm doing correct? Then please just ask us, and we're happy to help you out with how you should be doing that, the baseline analysis. We can help you figure out whether it requires an energy model or a spreadsheet is okay. And then for certain kind of special cases, which we'll discuss shortly, we can help you with how to actually do the baseline. One thing I do want to mention in the case of distributed generation projects, such as solar, the baseline analysis in those cases is a little bit simpler because your baseline is essentially zero. You're not producing energy currently, and then after the project you will be. But for those projects, you will still need to know what is the building using in terms of electricity so that you can do that cost-benefit analysis. Now I'd like to address two scenarios of projects that are not straightforward in how to do the baseline analysis. In some cases, for some projects, it actually might be more appropriate to use a modeled baseline rather than an actual baseline based on actual utility data. And specifically, I'm talking about two scenarios, both of which I want to address in detail. The first one is if you have a vacant or a partially vacant building which is being redeveloped. And the second scenario is a building repurposing scenario, when you're taking a building and converting it to an entirely new type of use. The first case I want to address is what happens if you have a vacant or partially vacant building. So in this scenario, you've got this building which is vacant or partially vacant. It's going to undergo a redevelopment, some type of project, and then after the project it's going to be used in the same manner that it was used before. So for example, you've got an office building, it's going to have a project done, and then after the project it's going to remain as an office building. So in this scenario, your baseline is going to be that you're going to model the building assuming the existing equipment, so the equipment that's in the building right now, but you're going to model it under the expected conditions. So these are what you would call your independent variables. You want to keep these constant. And that's your occupancy, the hours of operation, the load profile of the equipment, for example. Now you can use this technique if you have a limited amount or perhaps no utility data. You do have to know the existing equipment, so what actually is in the building right now. And if some of that existing equipment is missing, you can use an educated guess about what would have been there the last time the building was occupied. So for example, what was the code requirement when the building was last occupied? The next situation I want to address is a building repositioning scenario. So in this case, you've got a building, it's going to undergo a redevelopment, and then after the project it's going to be used differently than it was before. So for example, if you were converting a warehouse to an office space, what would you do? So for your baseline scenario, you're going to model measures that are going to have to be new to the building. You're going to model those assuming that they are compliant with the current energy code. And you're going to model it operating under your expected conditions. Okay, so hours of operation, occupancy, the load profile, all of those independent variables will be under your expected conditions. What this really means is that your energy savings end up being the amount of savings that your equipment generates above the code compliance levels. The last thing I want to address in this part of the webinar is energy models. If your project is complex enough to require an energy model, typically there's going to be an MEP engineer involved. Energy modeling software is fairly robust and ubiquitous across the industry. The most common ones we see used are eQuest and Energy Plus, the DOE versions. Trane and Carrier both have a building energy model, and DOE also provides a cool roof calculator for projecting savings from roofing projects. Part 3 in the webinar, we're now going to address the projected case. You've done your baseline analysis, and now you are projecting what will the energy use of the building be after the project. For the end result of this analysis, there's a few things that are going to be must-haves that we're going to expect to see. We're going to expect to see for each measure a description. What is it? We'll need to know a cost. And we'll need to know its utility usage. And that number should be not in terms of dollars, but it should be in the terms of the respective unit of that piece of equipment. So kilowatt hours, MMBTUs, gallons of water, whatever it may be. We also need to know operating hours, and if you have cut sheets on the equipment as well, that would be helpful. We're also going to expect that you perform an expected useful life calculation and justify that, and we'll discuss what that should look like shortly. And finally, you'll also need to provide your assumptions that went into your analysis, whether it's weather normalization data, occupancy rate, hours of operation, things like that. Now let's talk about the project useful life. All of our projects are going to have to calculate a useful life, and the reason for that is because the Texas PACE statute requires that the assessment period cannot exceed the useful life of the project. In other words, we're not going to finance projects for longer than they're going to last. Now that's pretty straightforward for a single measure, but you might be asking, well, what do I do if I have multiple measures, possibly with different useful lives? And in a situation like that, we will allow you to do a weighted average useful life based on cost. And I'll show you an example of the math behind such a project shortly. So what really needs to happen is that for all of our projects, the engineer or the contractor is going to perform a calculation showing the useful life of the project, and they'll need to provide some backup, where did they get their assumptions from, and then ultimately the useful life will be validated by the independent third-party reviewer. Let's go through a calculation of how to do a weighted average useful life. In this example, we have two measures. There's an HVAC system and an LED lighting system. The HVAC is going to cost $500,000 and its useful life is 20 years. The LED is going to cost $100,000 and its useful life is 10 years. So to calculate the weighted average useful life, you multiply the $500,000 of the HVAC times the 20 years, add that to $100,000 times 10 years for the LED system, and then divide the total by the total cost of the project, in this case $600,000. When you do that, you calculate a weighted average useful life of 18.3 years, which essentially means that the limit on the financing term for this project would be 18.3 years. Or in other words, we're not going to allow the PACE assessment term to exceed that weighted average useful life. With that, that brings us to the end of this section of the webinar. We've now created our baseline, and we've also created our projected case for our energy model. And in part 4 of our webinar, we're going to discuss how to calculate savings based on those two scenarios. From a high-level perspective, the methodology behind calculating savings is actually pretty simple. You take your baseline case, you subtract out the projected case, and the delta between those two, or the difference, is your savings. Now, obviously, I've made that sound deceptively simple. The devil really is in the details, and we'll discuss all of those details. But for now, I'd just like to emphasize that when you're doing that calculation, the importance of doing so in a so-called open book manner versus a closed book manner. And what I mean by that is that, when you're doing that calculation, you really need to show all of your assumptions, and you need to show how you arrived at your final numbers. And you have to do that because, keep in mind, as you already know, your work is going to be reviewed by an independent third-party reviewer. And in order for that person to do that, they'll have to see exactly how you came up with your conclusions. Essentially, they're going to check your math. So you need to do that in an open book manner. The most common question I get is, what can I count as savings? What can be counted as savings? And the overarching principle is that you can count something as savings if it has a demonstrable cash benefit. Now, the most obvious one of those is going to be a reduction in utility bills, right? So you do the project, and the facility's energy or water consumption or utility bill is going to go down. That's a cash benefit, so that definitely could count as savings. Beyond that, there's a number of other things that you could count as savings. The first one is the value of any produced energy. So, for example, a production-based incentive, or perhaps a net metering, perhaps revenue from a PPA. The next one is tax savings, and in the form of tax credits or depreciation, accelerated depreciation. The one caveat to keep in mind is that in order to claim tax savings, there has to be a tax liability associated with the entity that's going to take those savings, right? Because there has to be a cash benefit. So in general, nonprofits are not going to be able to take advantage of tax savings, or other smaller businesses that might not have a tax liability. Rebates count as savings. You're still going to be bound by the rules of whatever the particular utility's rebate program are, but certainly you could count the rebates as savings. And then finally, operational or maintenance savings. In general, we discourage those just because they're so difficult to justify sometimes. But if you really can show a history of outsized maintenance costs that will largely be diminished as a result of the project, then in some cases you could count the maintenance savings as well. What cannot be counted as savings? And it goes back to this idea of it has to have a demonstrable cash benefit in order to count as savings. The first one I hear a lot is staff time. So if you've got someone on staff who is not going to have to do some particular type of maintenance or activity or operational activity as much as they would have after the project, and they're just going to be shifted to other duties, you really can't count that as savings because they're still incurring that staff cost. The other one I hear a lot is this idea of capital cost avoidance, or I've heard it called deferred or avoided CapEx. And that really can't be counted as savings either. And the reason for that is because doing that analysis is essentially just comparing the same project using different financing methods, whether it's capital out of pocket or using PACE financing. And the reason it's inappropriate is because you end up with a blended baseline where you're claiming savings both from doing the project and in savings from the financing cost. And that really is just not an appropriate way to model savings from these projects. At the end of the analysis, there are two main outcomes that we're ultimately looking for. The first is on the savings side, and that will be in the form of a savings summary. We'll need to know what are the improvements, what are the measures. We'll want to know what are their utility savings, not in dollars, but in their respective utility unit. We'll want to know what are the utility rates that go into calculating the cost and the savings. And we'll also want to know any other assumptions that you made as part of the savings calculation. And then the second main thing we will want to see is the useful life. And we've already walked through what that calculation looks like, but it is something that we view as a key outcome from your analysis. You are welcome to present your savings analysis in any form that you'd like. We don't have a standard template for how you should submit it to us. But what we will ask is that we do have a standardized one-page summary table that will need to be filled out. And you can see right here an example of what one of those looks like. Essentially, we're just breaking the project down by measure and including all of the associated savings and cost for each measure. This table is going to go to the third-party reviewer ultimately that the ITPR will sign off on it. And it's so that we are just very clear on what is being claimed in terms of savings for each of our projects and standardizing how that information is displayed across all of our projects. Ultimately, all of our projects are going to be evaluated on their economic merits. And in the PACE world, not just in Texas, but really the entire country, uses a metric called the Savings to Investment Ratio, or SIR. The math behind calculating the SIR is fairly simple, fairly straightforward. We will sum the total of the savings over the life of the assessment, and that'll go on the top part of the ratio. On the bottom part goes the investment, where we will sum the total cost of the project over the life of the assessment, including financing cost. The inputs to the SIR are in dollars, and everything is non-discounted, so nominal dollars. We previously discussed what you could count as savings, but we also need to discuss what you should count on the investment side of the ratio. And the principle is fairly similar to the one from savings. If there is a cost incurred as a result of doing the project, you should count that under the investment side. The most obvious one and the largest one is going to be the financing cost, so the annual payment, both principal and interest, that goes into the PACE financing. Beyond that, if there's any additional capital expense due to the project, that should also be counted as investment. For example, with a solar project, if there needs to be an inverter replacement after 15 years or so, that should be accounted for. For an LED project, if the bulbs will need to be replaced at some point during the life of the project, that will need to be accounted for. And finally, you also need to account for any maintenance expenses. The ones we see most commonly are if there's some type of cleaning expense, for example, for solar panels. I want to walk through an example of an SIR calculation, and we're going to go back to our HVAC and LED lighting project. For this project, let's say our HVAC we've calculated is going to save $50,000 a year, and it's going to last for 20 years. Our LED project is going to save $20,000 a year, and it's going to last for 10 years. And the annual payment on the PACE financing is $50,000 a year, including principal and interest. So what we'll do is we'll sum up the savings on the top part of the ratio, so $50,000 a year times 20 years for the HVAC, plus the $20,000 a year times 10 years for the LED system. And then on the bottom part of the ratio, we will sum the investment. In this case, $50,000 a year in the payment times 20 years. We end up with 1.2 million over 1 million, or an SIR of 1.2. What this really is telling us is that the project saved more over its life than it cost. And so from an SIR perspective, that's what we're looking for. We're looking for projects with an SIR of 1 or greater, and so this project passes that SIR economic test. Anybody that's done any modeling knows that the results you get from your model will only be as good as the assumptions that went into the model. And what we'll do for all of our projects is we will take your baseline and your savings analysis, and we will run it through an internal analysis, internal to TPA, to Texas PACE Authority, and we'll corroborate the results you got in terms of the SIR. Generally, we will use, there's some pretty common modeling assumptions. For example, typically we'll allow utility escalation rates of about 2%. We'll do a savings degradation of about 1%. The typical solar production decrease I've seen is about 0.5%. Really, for any of your projects, if you have a question on what assumptions you think are appropriate for your particular project, please ask us and we can help you out with an answer there. This concludes the savings part of our webinar, and I now want to move on to part 5, where we'll discuss how the independent third-party review component will work for all of our projects. All of our projects in Texas are required by the Texas PACE statute, by law, to be reviewed by an independent third-party reviewer. That requirement is not optional. And it's going to have 2 parts. There's going to be a before component, so before the project component, where that third-party reviewer will review the savings calculations and they'll perform a site visit. And it will also have an after component, so after completion component, where the independent third party will go back out to the site and verify that the improvements have been installed and are operating it as intended. And we're going to go through those parts in detail. If we go back to our process flow diagram, at this point in the process, the energy analysis has been complete, and now the ITPR, or the independent reviewer, is going to review that analysis. This is the so-called before review, This is the analysis prior to project construction, and it really has four components. The first is a signed project verification certificate. The second piece is the ITPR is going to initial our savings summary worksheet. They're also going to attach a cover letter, and finally there is possibly going to be a report that details any of their findings or their analysis that went into their review. The first thing on our list is the so-called project verification certificate, and this is a form that you can find on our website or in our program handbook. And on this form, the ITPR is going to certify a number of things which we're going to go through now. The first thing they're going to certify is that they meet the ITPR qualifications. I've listed the qualifications here. The most important one is that the reviewer has to be a professional engineer, a PE, in Texas. They need to have relevant energy or water experience. And they need to have one of a number of credentials which we've outlined here on this page. The next statement will be a conflict of interest provision. You can see the statement word for word right here, but really the idea is that the ITPR is certifying that they are truly independent and that there is an arm's length relationship between the reviewer and the party that actually conducted the energy analysis. This is necessary because we want our review to truly be independent, and so we are asking our reviewers to make sure that the only role they held for any of our projects is that of independent reviewer. The next part of our form is a review of the savings analysis and the project useful life. The ITPR is going to certify that they performed a site visit and that they reviewed the baseline analysis and the projected case analysis as submitted by the contractor. And based on that review, they're going to conclude two things. First, that the reductions in utility use are, quote, realistic and reasonable. Now, they're not guaranteeing the savings from the project. There should be no liability on the ITPR in terms of project performance. They're merely stating that based on the project as it was presented and the assumptions that went into that the reductions really are reasonable and likely to occur. And the second thing they're going to certify is that the period of the assessment does not exceed the useful life of the project. Again, this is something that is required by the Texas state law. The last thing we're going to ask our ITPRs to certify is that the project is a qualified project, and that's all caps, qualified project, under the PACE Act. And in order to be a qualified project under the PACE Act, it has to meet two criteria. First of all, it has to be a permanent improvement fixed to real property, which really just means that the project is difficult to remove and is intended to remain with the property if the property is sold. And the second one is that the project has to be intended to decrease water or energy consumption or demand, and could also be a product, device, or interacting group of products or devices on the customer side of the meter that uses energy technology to generate electricity, provide thermal energy, or regulate temperature. So we are asking our ITPRs to certify to both of those statements. And what happens is that once that's done, the project is deemed a qualified project, and this cements its status under the PACE statute. And consequently, this is really what gives our capital providers certainty that the project is indeed qualified under the PACE statute and is a legitimate PACE project. Going back to our process diagram, the savings review has been complete. And the financing will proceed to close. Once that has happened, typically the project construction will begin. Now we know construction timelines can vary for projects of this nature. For smaller ones, the construction might take a matter of weeks. For larger projects, it could be months or even longer. And then after construction is complete, there's that final component of independent third-party review, which we'll discuss now. This step in the process we call the project installation verification. At this point, the project has been constructed and it has been completed. And our third-party reviewer is again going to be engaged, and they have another form to sign, which you can also find on our website or in our program guide. And this one's a little bit simpler. They're going to sign that form, the statement of compliance, and possibly attach a cover letter or a report detailing any additional findings they might have. The form that the reviewer signs at this point in the process, termed the Statement of Compliance, looks very similar to the form they signed beforehand. There's going to be a number of statements that they have to certify to. The first one is that they meet the ITPR qualifications, that they are qualified to be a reviewer in Texas. Number two, they're going to certify that they do not have a conflict of interest, that there is an arm's length relationship between themselves and the contractor. Three, they're going to confirm that they performed a site visit. And finally, they will verify that the improvements from the project have been completed and are operating as intended. At this point in the process, the project has been constructed. The last part of the independent review has taken place. And so from an administrative standpoint, the project is now complete. There are a number of issues that come up pretty often, and I want to spend some time now addressing those in the form of a frequently asked questions section. The first question we get asked a lot is long-term M&V required, M&V being measurement and verification. And the answer to that is no, M&V is not required, although it is recommended. Now we know that in order to maintain the performance from efficiency projects, you really need to operate and maintain the equipment as it was intended. And with PACE, that is an issue that is best left between the property owner and the contractor. It is something that an owner can choose to opt into, but they do not have to. The next question I hear a lot is who chooses that ITPR, the independent third-party reviewer? And the answer there is that that person is chosen by the property owner and the capital provider and TPA. The important principle to keep in mind here is that because there needs to be an arm's length relationship between the contractor and the ITPR cannot be contracted with the contractor. It really is someone that will be independent of the person that prepared the energy analysis. The next question I hear a lot is what can I include in the PACE assessment? And so I've listed a number of things that can go into the PACE financing. Generally, the principle is that PACE is intended to cover 100% of the cost of the project, both hard cost and soft cost. So not just labor and material. Now, the things on this list, not all projects will have all of these costs, but if those costs are associated with any particular project, largely they can be included in the financing, as PACE really is designed to cover all of the cost of the project. Some best practices for our ITPRs. One, I would suggest that very early in the process you make your expectations clear in terms of what you expect to see from contractors. Make sure that you are not doing their work for them. You also need to be very clear if you need anything revised or any assumptions updated. And ultimately, if you have any questions on how something should be done, please reach out to TPA and ask us for clarification. Some best practices from the contractor perspective. First of all, gather your baseline data and your equipment data very early. Make sure that your calculations are open book and that you have shown your work. Be very clear with your assumptions and label those assumptions so that the third-party reviewer knows how you produced your end results. I would encourage you to engage very early with the third-party reviewer and with TPA as often as you need help. And finally, don't just assume things. Feel free to ask and reach out to TPA. We're happy to give you guidance in how to do your analysis, and so we encourage you to do so. For any procedural questions, ultimately, if you have a question who has the final say on how something should be done, that decision will be left to Texas PACE Authority. So again, engage with us early and often. On a similar question, where do you go for guidance? Also, that's going to be the Texas PACE Authority. Feel free to reach out to us directly. We have an email address which I posted right there. You can also reach us by phone or directly as individual staff members. We're happy to help you in any way we can and to make the process easier for you. At this point, we have concluded the formal part of our webinar, and I'd like to open the floor up to any questions that you may have.